Hey everybody, it's Bruce Profits back again. I'm actually here to teach you how to day trade. My goal is to every day basically go over how to day trade. Every day this year, I want to make an archive of how to day trade so that way anybody who keeps asking me, my son, anybody who wants access to how to do it, if they're too lazy to watch ICT, they can watch me. So every day I'll be teaching it how to day trade. Here's just one payout I received from Apex Trader Funding, over $22,000. Did very well in 2024. It was a breakout year for me. I'm expecting to do very well in 2025 by managing risk, but I'm going to go over how to day trade, going over all aspects of it every single day. So feel free to join the stream. Feel free to get involved. But again, this is going to be important. Just to remember, it's a journey, right? But I'm going to start out with just basics every single day, and every day is going to be individual of the next. So you should be able to use each video to learn how to day trade. So the first thing I'm going to bring up, okay, I got a little web page here where I basically am going to be texting. So you'll be able to see what my thoughts are without me having to type it out. It'll just come through voice. Give me one moment. Let me just adjust this. Okay. So first and foremost, the most important thing you want to consider. So first and foremost, the most important thing you want to consider is the catalyst. What drives the markets? What actually pushes the markets to do what it does? So Inner Circle trader Michael Huddiston talks about an algorithm that, books price efficiently. And that's pretty much all I'm going to say about that. There's an algorithm that we can't understand, but we can trade with. We can essentially become algorithmic with our trading to be able to trade in alignment with that. So that is the very beginning. There's an algorithm. Now, despite whatever you've learned, I'm teaching or reteaching what he's taught. So if you're interested in another method, go somewhere else. I'm just going to be reiterating what he's taught in his lectures. The first thing is knowing the catalyst is the algorithm that drives the market. Now, on a day-to-day, what I want you to think about, I'm going to scroll down. What I want you to think about is what is required for us to trade. So our day-to-day catalyst is going to be news events. Most specifically, red folder news events. What is a red folder news event? I'm going to show you right now. So this website is Forex Factory. Forex Factory. That's going to be one of the sites that you're going to want to use every single day to identify what's happening within the market. I'm going to go to as if I just came to the site. So if you just come to the site, mine might just automatically go here. It looks like it automatically goes here to the calendar of news events. I don't really use this area up here. I use this area here. I try to see exactly what news events are happening every day. And that is actually that's what I'm focused on trading. The news events that are happening, if that makes sense. So what you want to do is every day look to find red folder events. And you don't want to actually trade during those red folders. You just want to watch the market and realize that it is a catalyst, but don't sit through them. Typically, it can cause a lot of damage to your account. Most traders trade during red folders without even knowing it. I'm just scrolling back to show some red folders. Obviously, December didn't have as many, but here's one, for instance. Friday, December 20th, red folder news event at 8:30 for CAD and USD. So I specifically only trade NASDAQ. So that's a USD-based indice or, instrument, I guess. So if you're trading strictly USD, we're looking about red folder USD. CAD also could affect USD, so you want to consider that as well. Let's say, for instance, you're trading GBP, which is like any GBP pair or certain futures that have GBP in it. I only trade NASDAQ, so my focus is on NASDAQ only. I recommend you only trade one instrument or one pair. I recommend NASDAQ. The volatility is nice. You can learn a lot by using prop firms. But again, we started with the algorithm. Now we're talking about the day-to-day catalyst. The day-to-day catalyst is the Forex Factory calendars. So you want to see the news events, red folders. So there's a few strategies you can use when you find out about the red folder that is going to occur. Give me 1 second. What I want to do is just take a snippet of this and bring it back to the text box. Okay, so now that we have the day-to-day catalyst, which is red folder news events, we want to go about thinking how we trade with them. So you either want to trade before or after these events. You don't usually want to trade through them, not as a beginner. Eventually, maybe some of your trades will go in alignment with them, but it is extremely risky and volatile to be trading during red folder events. So for instance, if there's a red folder event at 8:30, I would be sure not to be in the market at 8:30. I would want to be out probably around 8:20. Specifically speaking, my model happens between 10 to 11 and 2 to 4. So I wouldn't even be in the market at that time. Now, if there was a news event at 10 o'clock when I typically trade, I may look to get in the market earlier or later. So whenever there's a news event during the time you trade, possibly look to get in a bit earlier or a bit later. Okay. Those times do vary. There's a lot of research you can do online to find out when would be an opportune time to get in and out. But for right now, I want you to just realize the most important factor is the catalyst. So the algorithm, then news events. We want to stay clear of specific times. Those are the first two things with the trading. Okay. Third, we're going to talk about trading view. So this trading view kind of zoomed in too much on the screen. You're going to want to go to a website called Trading View. That's where you're going to do all your markups and analysis of charts. That's where you're going to be able to mark up what you predict price will do. This is my markup from Friday. I marked up price selling off and then potentially rallying back up. We got the sell off. I was able to profit on this. I was grateful for that. But you got to understand, you need this app Trading View. You need to go to the website. You need to download the app. You can start for free and then eventually pay for the paid version. If you're going to be trading futures, you will have to pay for the paid live data. And if not, you will have to have a prop firm account logged in to have that live data. So Trading View is really important to get your chart analysis done. Okay, so first Forex Factory, then Trading View. First, you need Forex Factory, then you're going to need Trading View, right? And you're going to do all your analysis there. Now, there are a lot of different type of trades you can take. I'm going to open up a new chart just to show the basis of what we're going to be looking at. Give me one moment. So I have a lot of different markups just to show liquidity. And again, that's going to be the most important driver in price action. So we went over the algorithm, we went over news being important, but as far as your trading goes, the key determining factor is going to be liquidity. For there to be a trade to take place, liquidity has to be ran. Now there are different forms of liquidity. The two forms of liquidity that you want to understand are internal and external. I can't spell, obviously. That's why I have that audio thing. I don't want to waste too much time trying to type things, but internal and external liquidity. So what price does is it goes from internal to external and external to internal, back and forth, back and forth. Some examples of that, I'll just frame a small example. So external liquidity is highs and lows, right? Extreme highs and lows, that is external liquidity. Internal liquidity is fair value gaps, any open voids, right? That'll be liquidity. So just for instance, on this chart right here, I wonder if you can see this. I'm a little bit too zoomed in here. Sorry about that. Let me move this over. Okay. Can you see this? Give me one moment. I just want to make sure you guys can see something. Okay, here's an example of liquid. There's plenty of examples, but I want to give a kind of obvious one. When price gapped up here, this created a level of internal liquidity, right? What happens is after internal liquidity is hit, what we typically see is we go back to external liquidity. So you want to approach the market with that mindset on any time frame. I know I didn't really give a good tutorial over TradingView. That's something you can find in another video. Right now, I'm currently on the 15-minute time frame, just looking at MNQ. That's the main pair and the only pair that I trade, or the only asset, the only market that I look at pretty much. I do kind of view some others for correlation purposes sometimes, but again, internal to external liquidity, that's the key. So here's internal liquidity here. What happens is when we came back to this price, we went eventually external. External is going to be old highs and lows in the markets. So this right here is going to be considered the external liquidity. Can't spell, obviously. That's and then down here, right here is going to be the internal liquidity. So I'll just put a little. Right. There's a lot of deeper knowledge to this. There's a lot more concepts that you can learn, but the basis I'm trying to teach is internal and external liquidity, right? So that's important. I'm going to make the list right here of the 3 things that we kind of went over already, just so we can stay on track. So the first thing is the catalyst. See, this is a waste of time. So I'm going to be more efficient moving forward, but the catalyst, because I'll have all this typed because I'm going to be repetitively teaching this every day. The catalyst, which is the algorithm, news drivers, aka, I can't really see this on the screen. Hold on. Let me zoom this in a bit better. Sorry about that, guys. I'm going to improve on this, but the catalyst is the algorithm, news drivers. I break that down to Forex Factory, right? So that's the first thing you want to think about every day, is just checking Forex Factory. Right. The second thing is TradingView. Markups/analysis. So this is for my son Bryson to watch. This is for everyone who's trying to learn. First thing is the catalyst, the algorithm, right? It's basically a computer program that efficiently books price, seeking buy stops and sell stops within the market. External liquidity, there's somebody's stop losses above here. Internal liquidity, somebody's stop losses here and below here as well. So you want to understand that when you use TradingView to look up to do markups and analysis, what we're looking for is liquidity, right? We want to identify liquidity. So that's step 3 in there. I'm going to add that. And I will get more proficient at this part of the teaching, but if you can bear with me and just learn, despite the shortcomings, you're going to do well when I actually get better at this. But the catalyst is the algorithm. News drivers, check Forex Factory daily. You're going to use TradingView for markups and analysis. We want to identify liquidity, right? Internal and external on the higher time frames first. Okay. So just so you know, internal and external liquidity does vary just depending on the time frame. So for instance, we're on the 15-minute time frame. This would be considered external here. This is internal here. If we go on a much higher time frame, let's say the monthly, we're going to see different forms of liquidity. Let's see here. So on the monthly time frame, right? We can look at some old price action. I know all that stuff is jumbled up here, but here's a form of internal and external liquidity working itself out again, because it's just a balance in price action. And we will go over different tips to ways to enter on that, but that's the main concept we kind of want to focus on right now, internal to external liquidity. Just give me one moment. I'm trying to grab a tool. I'm having a hard time. This is right here. Let me find it back. Don't know where it went. And this is live, so sorry about that, but I have to take my time doing this. So, for instance, on this weekly time frame, right? What we have right here, these highs, right? These highs right here. At the time, if we did no price action, right? This would be considered external liquidity. External, right? It's an old high, which can be categorized by a swing point. A swing point is going to be when one candle has the candle, like let's just say we identified this candle right here. The candle to the left of it has a lower opening and high, and the candle over here has a higher opening and high. So that technically wouldn't be a swing point. This one would be, as long as the candles before it and after it technically have a lower opening. So it's not the best from this time frame, but you may have to watch another video on swing points. I'm going to work on explaining that better, but essentially it's just an old high or low. So if you identify that old high and then you realize that that is external liquidity, right? Then we want to actually take internal liquidity back to that level. Now, how can we get internal liquidity back to that level? Multiple ways. We just look for order blocks or for value gaps to be filled in. So right here, this right here is considered a fair value gap. And that's something that, again, please go study other videos, but this candle before and after, the wick, which is the little line on top of these candles, they did not overlap. It creates a gap in price where it's inefficiently booked, where there was only buyers and no sellers. So it needed to be rebalanced. Price came back in and tapped in right here. That is the same type of trade as over here, right? Where we came back to an imbalance and then we sought external liquidity, right? So internal to external. So even if you just looked at this as internal and right here is external on this lower, smaller candle right here, that itself could have been a trade as well. And to frame the trade, right, this is a tool right here where you can go long and short, just to hypothetically give you a concept of how the money would work. You'd put a long position when price tapped into that internal liquidity point, and then you'd basically adjust the stop loss to be either the full candle of that liquidity area, 50%, right, or the swing low, depending on the time frame. So in this time frame, we wouldn't use the swing low, we would just use the candle, right? So that, since this is a higher time frame, this is a monthly, this would be about 700 points, right? And if we're targeting the external liquidity, we can get about almost a 2-to-1 out of it, which is perfectly fine considering that we really didn't go into any drawdown. You could have added to the position as it was approaching target, which is a key factor in my trading. But this tool shows you how many points would be actually at risk. 702 points, 1,300 points. If you trade one micro, right, that's $2 a point, $1,400 risk for, right, for about $2,600 profit, right? And that would be an okay trade, again, if you're trading on a longer term basis. Me personally, I'm a scalper, so I'm doing this on the lower time frame, but I'm just trying to frame what external liquidity and internal liquidity look like. This would be internal liquidity right here, right? And then this candle right here. And again, we were looking at an even higher time frame, but there's so many trades when you use this that occur that you could actually wait for a price to come back to certain areas. External, right? So I'm going to get better overall eventually at explaining all of this stuff, but for right now, just think external to internal liquidity. And then on the bigger time frame, it occurred again. Price dipped back into internal liquidity and went back to external. Now, to make this very simple, I could teach order blocks, breaker blocks, and all of that, but what I want people to start thinking about is just basic OTE. So does price come back into or near the 50% level, 62% level, or 707? I think it's 705 by ICT's numbers, but some people use 61.8 as a golden ratio. There's a lot of different ways people can look at it, and there's a lot of different levels people can have in their chart. As long as they have 0.5, about 0.62, and about 0.70 and change, that is an area where you're going to be wanting to buy or get in a trade, and then put a stop loss typically below this region here. If you're taking this higher time frame trade, excuse me, it would be framed like this, right? Stop loss could go below the low of the candle that created the internal liquidity. So this would have been a great risk reward ratio trade. You could actually hold this as a stop loss if you wanted to have a wider stop. Again, you'd have to adjust your risk management in that scenario, but what have we really went over here? I'm going to go back to this doc. Go to a fresh page. Okay. We currently have been discussing internal and external liquidity. Let me make this bigger. We have been discussing internal and external liquidity, right? Step one is, you can't even see it on the screen. Sorry about that, guys. Hold on. Fix this too. Step one, identify the catalyst. Step one, identify the catalyst. That is the algorithm, as well as news drivers for that day. Step two, log into TradingView, mark up liquidity. That is internal and external. Mark up fair value gaps, order blocks, breaker blocks, old highs and lows on a higher time frame perspective. Right? So back to this chart. Let's pause this. Back to this chart, I'm going to erase everything off of this. So once you've come to a chart and from a higher time perspective, you mark up liquidity, then you can go on a lower time frame perspective and take advantage of that narrative on the lower time frame, right? So let's just say hypothetically we're on the 15-minute. We're going to jump back down to the 15-minute because it is all relative. Higher time frame, let's say for instance you scalp on the minute or seconds chart, higher time frame can be the 15-minute, right? And ICT talks about 15-minute. Let me adjust your guys' screen. Sorry about that. The 15-minute having a lot of relevant liquidity pools. So that's kind of where the majority of the trading, on an intraday basis, there's some really good benefits there, especially if you're, scalping. Let me zoom in on these candles. I want to make sure that the candles look beefy. Give me 1 second. This is something I will be working on. Just making sure that you guys can see everything in a better format. Okay, that's not going to do it. Give me 1 sec. I just have to do like a weird scroll. It's annoying. But what we want to understand is trading internal to external liquidity. Here's an example again right here. We have as a fair value gap, also known as a BISI. Fair value gap. Oh, why is not? Got to double, triple tap it. Fair value gap / BISI. A BISI is a buy side inefficiency, right? Buy side, sell side inefficiency. A fair value gap is the same thing as a BISI. It's just if it's a buy side fair value gap, we call it a BISI, right? Let me zoom in. You could already see it, but the candle before, the candle after did not overlap. I'm going to move the fair value gap and see. They did not overlap. They left a gap. If I put lines there, just so you can see like how from a line perspective it would look. This line right here. Well, if you turn on the magnet tool, you can actually make it hop on. So that line right there and this line right here, not overlapping, created a fair value gap, right? It's this expansive candle with a gap in between. What makes it even more juicy is, right, we had an area to the left of it. I'm trying to look for the right drawing tool. I should have all this stuff in my little thing right here, but I don't know where it went. Let me see. It's crazy. I lost that stuff the day I want to show everybody what's going on. But bear with me, guys. We're going to do this every single day. So there's an opportunity to grow every single day. But this area right here, right, this swing point, we retested this swing point. There's a internal, right? This is internal liquidity. We labeled it fair value gap and busy. We can label it internal liquidity. And then we're targeting external liquidity. So if we're getting in the trade like this, right, we're looking for price to hit this potential area right here, like an old high as a target. And then if we have the framework for that, let's just say hypothetically we entered right as it broke into the gap. I'm gonna move this over, even though we know what happened or whatever. We're gonna show that if we lowered this target to right here, and we adjusted the stop loss on a buy trade to below the candle body that created the fair value gap, even if you use the wick, if you use the wick of that candle or close to it, even though that's not what I would do, you could still get a 101 out of that trade. And that's still something you could take with one contract, risk $120 to make around, 120, 130, a little bit more, right? I would actually use the candle body for this one. And it would be let me turn off the magnet. Sometimes when you have the magnet on, it kind of messes it up. So I'd be using the candle body, 35 points, and then I'd be targeting for about, let's just round it to 70 points. So about a 2-to-1 on this trade. Mind you, that's if you get in, well, actually, let me adjust it again. If you get in right here, 2.5-to-1, right? Mind you, that happened, you can enter here. Price came back, you can find another entry because again, there is multiple inefficiencies. Inefficiency is that internal liquidity I was talking about. Here's another one that you could have used probably on a lower time frame. Price respected this one, even though it tapped through it, it respected it and closed above. So there's multiple attempts you could have had to target this level of liquidity and framed out a trade. The point is you got to understand internal to external. Now, one cheat code you can use is OTE. So he does teach about OTE, which is price pulling back to between, I believe, the 61.8 to 70.5 or 78.6 level, just give or take. And what you're going to want to do is you're going to want to use a level relative to price being ran, a market structure shift. So it's like you could mark up every little level's fib, but you want to look at a level like this. This is the last green candle before the last bearish push that's taken out here, right? So right here ends up becoming a market structure shift. Some people just trade based off that, which is fine. But whenever you see that, you know that you're going to measure, right? You're going to measure on a lower time frame or potentially that same time frame, a fib level to see if you can find a trade. So in this scenario, let's say hypothetically you try to measure this entire level up to here. It doesn't come back down into the range in order to get into a trade, right? So again, I'm a scalper. Sorry about that, guys. I don't know why I just did that. I think I went to the wrong, it actually switched pairs. Give me one moment, switch back. Sorry, I'm still learning how to stream effectively. So what you're gonna wanna do is get back to the area that you were talking about right here. You're going to want to frame on a lower time frame the Fibonacci level. So let's go to the 5-minute. We were just on the 15-minute. Let's go to the 5-minute. So based on the area that took out this level, I would say is this green candle right here. I'm going to zoom in so you can see it better, right? I'm going to turn off the background colors on this so that way it doesn't, there's no overlap, right? It's a lot of things going on. We can remove everything. Remove all the drawings. Right? This is the fair value gap we identified on a higher time frame. Right? And the key is understanding, when I say make it easier, use OTE, you need to have an understanding of price action first. So we needed to see the relevant level that sent price down be ran. This candle, this big green candle that broke out, it ran multiple relevant price levels. On the higher time frame, this level was a little bit more relevant. On this time frame, 5-minute, this level is relevant. So both those levels were ran. Okay. There's a lot of other concepts that can be seen here. This could be considered a breaker block. Like these are concepts that if you learn them, you can use them. I use breaker blocks, but you don't need that, right? You can wait to a better entry or more safe entry. This entry is really great because guess what? It happens at around 12:15, around lunchtime. You know, it's something where you don't have to immediately be up awake to take advantage of, right? So this is how I would say use the fib. What you're going to want to do is you're going to want to measure this range here where that green candle actually took off down to up to that. So to put the fib, you start from the low here up to here, right? So price came back down and tapped that 62% level. Some people would say adjust the fib to here. You have to just be consistent in how you mark it up, right? So you're going to want to just get used to the levels, which are 0.5, 0.6, 0.707. I do have 0.82 on here, but typically I don't use that. Price came back into that fair value gap under the consequent encroachment of it, under 50% level of that fair value gap, which is very telling of price wanted to go bullish. So price wicked the 707 level if you measured from this candle body. And that's typically what you want to do. You want to measure from the candle body, not from the wick. So it wicked the OTE level, right? That in the fair value gap is all you need, right? Once you learn that, you don't have to overcomplicate it with a whole bunch of concepts. So we have the catalyst, we got the charting platform, we know we're doing internal to external, right? So now we got to talk about risk management. I'm gonna go to the other screen. Let's go here. Hopefully you guys are taking notes. Why is this doing this? I'll just be talking to you guys. Hopefully you guys are taking notes and you're starting to understand what is needed in order to frame a trade. We went over the catalyst, right, which is the algorithm, prices attacking buy stops and sell stops of traders, right? So we're basically trading traders at this point. That is what smart money is. That is what Michael Huddleston teaches. I am nowhere near his level. There's other students on an even higher level. I'm just trying to reach people who can hear me and, more importantly, document for my son. So my son is able to use all of this rhetoric, all of this proof, all of this history to create his bias and to create his model. Now I'm trying to help everyone create a very simple model, or not even create, but just to use the 2022 model. Basically just use a fair value gap and maybe even combine it with OTE for those who like the Fibonacci levels. You want to make sure that you're entering when there's a market structure shift and then price retraces back into a level. So you want to see a pullback. So it's a break and retest essentially, but most people don't know what levels to look at for the break and retest. One key component to this model is looking at a higher time frame point of interest. Now I'm going to list out a few different higher time frame point of interest that are very relevant to me. The first one is previous day high, previous day low. Now, there are higher time frame levels that are even more important, such as weekly high or previous week's high, previous week's low. But for me, I love previous day high, previous day low as a scalper. That gives me an opportunity to get in on a move with a lot of volume. And that's what I've been monitoring. You can use indicators on your trading view levels to see those levels, previous day high, previous day low. As well, let me go here. I'm going to mark up some of them so you guys can see what it looks like. I'm going to go to a 1 hour chart, kind of zoom out a little bit. Right. Go to the daily chart actually. So I'm going to mark out some previous day highs and lows. And then we're going to look at how price reacts around them. So the main thing about our model is you're coming at a certain time consistently to the market, looking for your higher time frame point of interest to be interacted with. As long as it doesn't overlap with your news releases and everything like that, it should be, a decent trade, or you should be able to frame a trade. Some days you won't be able to, and that's okay. But again, every day I'm going to be going over how to trade. This is the first stream where I'm kind of just, getting into it. So hopefully everybody's liking it. But regardless, for the last few days, if we just let me put the magnet tool. I need to zoom in a little bit. If we just frame all the previous day highs and lows and see when there was a trade to possibly take at those levels. Let me see. I'm literally just going to mark up every single previous day open, high, low, and close, right? Because each previous day open, high, low, and close creates a trading opportunity. And that's something I didn't really go over in this video. The importance of open, high, low, and close of each candle. So for a red candle, the open is the body high, For a green candle, the open is the body low, and then the wick low is like the actual low of a green candle. And for a red candle, the wick high is the actual high of a red candle, right? So open, high, low, and close. So you want to get that concept. It's fractal. It goes throughout all time frames. It's going to go over your head now. It's going to go over your head for the next 5 years, probably. One day you'll realize that that's actually all you need. Price accumulates, manipulates, and distributes. That is in another video that I made. I will touch on that at some point, but I'm just right now going to go over an example of higher time frame point of interest that you should focus on, just based on like as far as organization goes. You want to be looking for all of these levels, and it's like, what is he marking up? He's marking up every level. You don't have to do this. I'm just trying to show you how each level, when you zoom in, there's going to be price action that was tradable. There's going to be a setup that we can describe in a better context, just based on what happened. Again, that was on the daily time frame. So here we go. I didn't even label them for what they were. Price came back to this level, an area where you could have took sells. Right here is a bearish fair value gap. This is just the 1 hour chart. So you can use these concepts on pretty much any time frame, right? Price came back to a bearish fair value gap. So what is this? Internal liquidity. What are we seeking? External liquidity. And external is relative. External could be here. It could be the full, and I'm going to change the colors. All the colors are the same recently, so that's not good. But essentially, this internal liquidity, right? We can use that to target external liquidity down here. All because, and you can put the stop right here actually, all because price came to this level and failed. That's a higher time frame point of interest. These are all daily levels. Came to 2 of these levels and failed. Came to 3 of these levels and failed. Came to 4 of these levels and failed. Came to 5 of these levels and failed. And then finally, we did retrace back up, and then we hit that target of internal to external liquidity. Again, there's more external liquidity down here, so we might be targeting this level, right? So that's how you go from a higher time frame, and you can start to kind of build like what's going to happen. Now, from a scalping perspective, I'm going to go to even lower time frame, 5 minute. There's small trades within each of these levels, right? So price came here. Zoom in, make sure you can see this good. Price came to this level right here and took out liquidity, right? This was liquidity. This body, this wick right here, before all this price action happened, that was liquidity. So price came and took it out, right? Once that happens, the first trade is known as a turtle soup, then unicorn, then 2022 model, then there's a lot of other entries I can't really name. And I may have misnamed some of them, but if you watch this market maker model video, you'll understand what I'm talking about. I'm really just teaching you how to enter on the 2022 model or the silver bullet / OTE model, right? But to start any trade, you need liquidity to be ran. So liquidity was ran here, and there's open internal liquidity that has not been tapped into. So that gives you a premise of, I can potentially sell above here to get back to this internal liquidity to be filled, because price needs to fill the internal levels. As you can see back here, this occurred here as well. Price came and filled the internal levels. So sorry, let me move this over. What is this? What is even that? Let me delete this. So what happened is price eventually broke down and took out that liquidity. Now, how could you have entered to take this trade? There's multiple ways. Number one, you can trade turtle soup, which is when it breaks above this level, and then there's a second break above a lower time frame level, which is, this is a break above a level right here, and this is another break. Then you could have took a turtle soup trade. That's what I would have done, right? That's how I trade. It's aggressive, but as long as you manage your risk, you can scale into these trades, and it really works out well. Second, once the market structure shift officially happened, which is, let's say for instance, this green candle or this candle right here, once it's officially broken, that's telling us we're going bearish, right? So then anything that was going to be previously used to go bullish becomes a bearish tool. So this fair value gap from this candle right here, that used to be a bullish fair value gap, it used to be a BISI, it becomes invalidated and gets turned into an inverted fair value gap. Now, once you master fair value gap, you can use inverted fair value gap The key to this is simply not living and dying by every gap, just kind of monitoring them to learn how to use them. A gap near a break in structure is very important. If that gap is not used to explode up, it's going to be used to explode down. And that's what happened. Price came back into this gap multiple times. And this is the 5-minute time frame, meaning once price broke this gap and came back, this is how many times you could have entered or how much time you had. From 6:45 all the way till, sorry, this needs to go away. From 6:45 all the way to 21:15. Which is, sorry, my math is bad. 21:15 is like what, 7 something? So you had about an hour per se to catch this sell-off, right? And later on, there's going to be more entries based on those levels we mentioned, but I just wanted to frame one. The first one is going to be the turtle soup. Then you're going to have the unicorn entry, which is a breaker block being tapped into, so you with a fair value gap. And it's not really going to be seen on this time frame. I'd have to go to an even lower time frame, but you can take my word for it. Once you study unicorn, which is in a separate video, you'll understand what I'm talking about. And then 2022 model is just taking a fair value gap in alignment with that. So hypothetically right here, there's like another little fair value gap that could have been used, right? And you could have put it above the swing high considering the price action. And then if, let's just say hypothetically you took this trade, stop above the swing high right here for 16 points. You can't really get better than that. And then you're targeting, you can target this candle equal, the body lows here, right? Or you can target this order block / breaker, whichever one. Obviously, if you let price come that close and you don't close out, that's up to you. But eventually it does melt. Now price taps back into more levels of liquidity, internal liquidity right here to sell off. Now the times that this happened, it kind of aligns depending on what your day is. This is 6:20 in the morning. This is very early. And I think this was actually midnight open. And that's another level I want to mention. So we're talking about a lot of stuff. The main reason we got all into this trade is because we're looking at a higher time frame point of interest. All these blue lines were marked up on the daily. They were marking up the open, high, low, and close, right? So once you mark those up initially, just to learn like, okay, there are reactions at these levels. How can I frame a trade there? Once you figure out which trade you can see the best at those levels, great, right? But we're scalping them. We're going on a lower time frame. We're looking at that level and saying, okay, I know that price is drawing to a certain liquidity. How can I use one form of liquidity to get to the next? So right here, price pulled back, and it's very fine on the 5-minute. On a lower time frame, it would have been a little bit, I guess, easier to see, but price pulled back, failed to go above this gap, and then melted lower. On a lower time frame, there's probably another fair value gap being tapped into to sell off of. Right here, there's like a small gap being tapped into to sell off of. And you got to understand that these inefficiencies within the market is what creates that price action to trade, at least from my perspective. Right here was a buy trade that I missed. I was upset about this, but I did catch a good sell trade. I'll show you both of them soon. But look, this buy right here, because there was a market structure shift. There was the higher time frame point of interest right here that got wicked. All right, get the higher time frame point of interest. We got the market structure shift right here. For me, a market structure shift is also when a fair value gap gets invalidated. So when you are going down, you want to see all the bearish fair value gaps like keep sending price down on a lower time frame. And I got to zoom. On a lower time frame, there was a point in time when a bearish fair value gap failed. And then that kind of will tell you that's also a market structure shift. That's a little gem. Give me 1 second. I'm trying to zoom in to show it. So here we go. This fair value gap right here eventually failed and was used to go bullish, right? That IFVG, which if I try to type it in there, it'll be too small. So I'll just type it right here. That's the IFVG. Then right here is the fair value gap. Now, if you align both of those, that in itself is its own trading model. With ICT's concepts, you can create hundreds, if not thousands of trading models. He has labeled a few of them. So when you have a fair value gap, right, aligned with a breaker block, which is an order block that gets mitigated, taken out. So that's a higher level concept. It's going to be hard to kind of teach a beginner that one. But the long and short of it is use a fair value gap, take out that Fibonacci, mark up a relevant area that created the market structure shift in price. This area was market structure shifted. You put the fib here, price comes back to that OTE level. That's in alignment with the fair value gap. It really doesn't get easier than that. I kind of went over some harder concepts so you can kind of see like, okay, OTE actually does all of that. Technically, you need to learn premium and discount as well, right? So that's something else you have to learn. We only buy in a discount. We only sell in a premium. So relative to price action, ICT kind of labeling. So once you know the catalyst, what time did it occur? The time is down here. Most of these trades like this happened between that 10 to 11 time frame. That's that silver bullet trade I'm trying to teach everyone. It aligns with OTE as well, right? Depending on the time frame you go to, you can find a lot of OTE trades, which is price pulls back to a level in a discount so you can buy it and get out before it makes extreme highs, right? If you got in here, you can get out right here. You don't have to hold for these extreme highs. But again, the motivation to get in these trades has to be that higher time frame point of interest. So these are just lines I put on the daily chart. Open, high, low, and close. Please go learn that. I'm going to keep saying the same thing every day until you realize like you need that higher time frame point of interest to scalp.